Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. Today we're talking about the fundamental challenges the commodity markets face and the funding gap that result. What are the challenges? What does it mean for pricing risk in the markets? And what is the role of investment banks as we go through a period of high risk, high volatility, and increasing need for risk management services? Our guest is Nick O'Kane. Nick is the head of commodities and global market at Macquarie Group. Now based in Sydney, Nick has spent over 25 years with the bank and has been instrumental in growing their commodities offering and subsequently leading it over the last 20 years. We're delighted to have Nick on to celebrate our 100th episode of the HC Insider Podcast. As always, if you enjoy the show, please do leave us a positive review, and I hope you enjoyed the episode. Nick, thanks for joining.
Thanks, Paul. Thanks for having me. It's hard to believe it's been a few years since we last talked.
You really launched the HC Insider in conversation for us, so excited to have you on for what was going to be our 100th episode. So thanks for doing it.
Yeah, no, look, really happy to be here, and congratulations on the success of the series so far.
Thank you. Right, so we are talking about the funding gap in commodities, the role of investment banks more broadly within that, and of course what is going on today in the commodities world and this sort of new normal of high volatility, high prices, high risk, etc. Before we sort of dig into some of the solutions and the challenges the sector faces from a funding standpoint, can you just diagnose for us what you think the fundamental challenges, if they are indeed challenges, the commodities sectors face today?
Well, I think some of the challenges that the sector is facing are not that different from the challenges we've faced in the past, given the cyclical nature of this sector that we operate in. Things may be, some slight nuances that are very specific to the conditions that we see today. But overall, the cycle that we're going through is not that different from the cycle that we've seen previously. Over the long term, commodity prices tend to move with levels of growth in GDP, and that's not that dissimilar to what we've seen driving a lot of the increases in prices over the last couple of years, although we do have a couple of new challenges, I guess, in terms of geopolitical instability, something that we haven't really faced in a significant way for quite a few years. And we've had a little bit of underinvestment in fossil fuels over the last couple of years as well, which has resulted in some supply constraints globally, which have been impacted by the growth in industrial production over the last couple of years, which has meant demand for energy has increased when perhaps there's been somewhat of a underinvestment in supply. And then there is the energy transition, which we're working through at the moment, which is changing the landscape for some metals consumption, and also changing the way we are looking at producing energy both now and into the future. But overall, if you take a step back and think about what drives overall commodity prices, it's the level of actual economic growth that drives it more often than not. And then we always have some idiosyncrasies that might be driving one part of a particular cycle or another.
Yeah. When you compare, and there is obviously a lot of talk about a super cycle. The last one that was diagnosed was, the 2000s, primarily related to China's growth and demand for commodities. Do you see this as a true swing up in that cycle, or could it just be a temporary rebound from lockdowns and COVID?
Look, I think you need to take a view on where you think long-term global growth is going. And if you're thinking that we're going to see sustained global growth over a long period of time, then you'll see sustained growth in commodity prices. So notwithstanding that backdrop, I suspect, depending on what your view is there, and we are seeing governments and central banks at the moment react to inflation that's crept its way into global economy. So we're seeing interest rates rise quite rapidly, and that will probably have an impact on global growth. So therefore, you can extrapolate what you think might happen to commodity prices from that perspective, with the nuance of a couple of things that are happening in the short term, which is around energy supply related to things that are happening in Europe and potential impacts of demand coming out of China as well. So I think there will be those idiosyncratic issues that are happening in various places throughout the sector. But overall, if I think about a super cycle, I think I'd be more inclined to align that with what global growth will look like over coming years.
Yeah, interesting. But then there are these sort of the idiosyncrasies of this particular time compared to previous events, which is it's happening in a deglobalizing world, arguably, or at least there is pressures on free trade, particularly around energy. And you're also dealing with extreme levels of volatility that we've seen in the metals markets and then the energy markets again. So can you just talk to those 2 points, especially, I guess, starting off on how the geopolitical landscape it might exacerbate the ability of commodity traders or the markets to level prices and move and transform those commodities in space and time?
Well, I think when you've seen this period of underinvestment that we've just gone through for a couple of reasons, whether that's been a period of low returns for investment in fossil fuels prior to the most recent rallies, or whether it was related to other pressures in terms of changing demands from stakeholders of organisations that lend money, so things like ESG and various other things. We did see that period of underinvestment, and that's meant we've had a really tight market from a supply and demand perspective. And when you have a tight market, even the smallest changes can particularly have an impact in terms of price. And that's why we're seeing the levels of volatility that we've seen. And then on top of that, you start to see something like the conflict that we're seeing in Ukraine, which had an extremely significant personal impact and a devastating one to many people. It's also added this new dimension in terms of supply uncertainty as to what is happening with supply coming from things like the global oil market or natural gas market in Europe, that impact that has then on electricity prices, but also some of the other agricultural commodities as well. And there is a tremendous amount of uncertainty that's coming from this conflict and what will ultimately be the outcome and what's the impact on economies and ultimately what's the impact on humans and society. So we started at a relatively precarious position, and then we've had some significant shocks, and those shocks have meant substantial volatility as participants in the market try and understand what the implications are, not only in the short term, but what are the implications in the long term for these macro shifts in terms of where things like energy are going to be produced and how we get it to where it is being consumed.
Yeah, which I guess comes back to this narrative that's out there about typically, investment capital flow into commodities when there's a rise in prices. And there's, to some extent, that investment hasn't really come to fruition over the last 2 years or so, as you pointed to. Some of that is ESG and energy transition, and some of that is also uncertainty about where to invest, now exacerbated by geopolitical conditions. Can you just talk to us a little bit about, as Macquarie being very much a bank focused on energy and commodities itself globally, where is that, how is the twin issue, the twin challenges of investing with an eye on sustainability and also now this high level of volatility, how is that impacting investment flows to commodities? And indeed, what solutions can you offer to encourage it?
Well, as you know, from Macquarie's perspective, we've been a long-term investor in renewable energy and one of the world's largest investors in wind and solar, and something that we've been doing for 20 odd years. But we've also had significant levels of participation in other parts of the commodity spectrum as well. And look, when we're looking to participate and invest in these opportunities, we're looking at the similar types of things that we've always looked at in terms of what's the benefit to society of building the production that's getting that's getting built, what issues are we solving from a supply and demand perspective, and how does it ultimately contribute to overall energy stability? And that sort of continues, and that's the way we'll always look to assess the types of activity that we're involved in. And of course, whenever we're looking to make an investment, what we like to understand is just how much of the commodity exposure can be hedged, and how much of that commodity exposure needs to be hedged to be able to ensure that the debt can be repaid. And that's a really significant role that the financial markets can play in terms of commodity space, in being able to give investors and equity decision makers confidence that they can get a return on their investment by giving them some certainty and confidence over their future cash flows. And that's a really important role that the derivatives markets play in ensuring that the right amount of investment takes place at the right time to solve some of these issues.
Yeah, and so staying with that risk management, for the last 8 years you've had, or at least sort of the mid 2010s, it was a period of extreme, of low volatility, and also low returns, and that meant, from just conversations I've had on this podcast, you had corporates out there that had perhaps let go some of their more, or their focus on risk management that they had in the 2000s when they did see their feedstock prices go up. And also it meant that there are fewer organizations out there who have that kind of capability to manage those risks, be it independent merchants or be it commodity trading arms of investment banks. Can you just talk to that? Because suddenly now in this period of high volatility, I can imagine that's something that's in great demand, but is really quite challenging when you're facing the markets like we are.
Yeah, it's been interesting, and I think throughout that period, especially towards the latter part of that period, attracting young people to come into the industry was more difficult than it was perhaps the early 2000s to mid 2000s, where it was considered to be quite an attractive industry for young people to join, and I think we were competing with tech companies and various other potential employers for the brightest talent. So as a result, I think there had been a little bit of an underinvestment in terms of the amount of talent that was being developed across the industry, given there was probably more exciting things to do elsewhere. However, with a sort of an evolution of approach in the way that the market looks at assessing risk and indeed trading and the continued importance of data and mining of data and understanding how to use big data, I think we're starting to be able to attract the best and brightest minds back to working in the industry, and that's good for everyone, because ultimately it ends up we end up with better solutions, and whether that be for our corporates or utilities that we're helping manage risk for, or whether that be in terms of just overall efficiency of the way that the markets are operating. So I've been really pleasantly surprised by the quality of interns and graduates that have been entering the industry over the last few years.
Yeah, I mean, fundamentally, though, there are still far fewer seats out there at the moment because there was a big contraction in the number of participants as a result of regulation and an opportunity, that it's going to take quite some time to build up that stock of individuals who have commodities expertise like we had back in the mid-2000s, right? So I still think there is, sitting on my seat, there's still a real challenge the industry is going to face if indeed more new entrants come into the space and existing participants start to grow their desks as the opportunity increases.
Yeah, I think that's a fair comment. That will take some time to replace, but will we need the same level of seats that we had previously as technology has evolved and we as businesses are more efficient than we perhaps were 20 years ago?
Yeah, no, that's definitely true, right? Whereas a natural gas desk would have many people on it, now today it's much smaller as a result of, as you say, automation and technologies available. But coming back to risk, do you think, because again for a long time there's an argument out there that essentially commodity risk has been underpriced. Do you think we're in a period of essentially a big risk repricing going on in commodities, given the events of the last 6 months to a year across whether it's gas, metals, oil, ags, etc.?
Yeah, it's a really good question, and it's one that we spend quite a bit of time reflecting on. And obviously, we get real time information from our interactions with the marketplace on that question itself. And look, the reality is that after you get a period of extraordinary volatility like the one that we've just had, you will get an adjustment in pricing. And there's a couple of different ways it might manifest itself. So we've got the adjustment in terms of the actual level of volatility that might reflect in the way that we price market risk, but it also has to reflect the way that we price credit risk as well. And then I think a lot of participants are assessing the way they price other non-financial risks as well. So what we are seeing in the very short term is a reaction to the market level, the activity levels that we have seen, or the volatility levels that we have seen. Now, how long that remains for is unknown. I do think risk management products will be getting more expensive as these levels of volatility start to feed through to all of the various participants' pricing models. And in some cases, we've seen that come through already. In other cases, then we'll see that feed through over time. But historically, what that has meant is once we've seen a bit of a repricing for commodity risk management products, other participants who have not necessarily been involved in the market see the attractive yields, then they'll come in and start offering similar competing products, and then prices tend to retract a little bit. So that's sort of a normal cycle that sort of pricing of risk takes across the commodity markets. Having said that, some of the moves have been so significant, and some of the challenges and changes may be structural, given some of the topics that we've already talked about earlier. I suspect we will see long-term impacts of repricing of risk, but I'm not sure how significant they will be.
When we last had a commodity supercycle, much of the risk management was done OTC, right? Since the global financial crisis, much of the derivative world has moved on to exchanges, and those exchanges have become ever more granular in the products that are available on them. Does that make it easier for participants and also corporates looking to come in and hedge to get those services? I mean, how has that changed, if anything, that risk management landscape?
Look, it comes down to your access to funding. And I think what we've seen most recently is that accessing exchanges is, prior to cost of funding, a cheap way to access risk management product, although it's obviously on an exchange, so that there isn't the flexibility to make it into a bespoke product that might better reflect your actual exposure. So you have that playoff between something that's vanilla and uniform versus something that can be actually tailored specifically to your exposure. However, for that trade-off, it is cheaper. But what we did see over the course of the last 12 months or so is it can require a really significant amount of funding. And that's why the OTC markets developed in the way that they did, is that for certain customers that don't necessarily have the access to funding or the ability to call on funding lines quickly, they're better off putting on an OTC product and have that OTC product match their cash flows, so that the treasuries of those companies can better manage their own liquidity and not have to draw on funding for margin calls that don't actually reflect their underlying business or their underlying business activities. So we are still seeing a healthy demand for OTC product for those reasons, and particularly after the challenges of the last 12 months, where people found themselves with margin calls both from initial margin increases from the exchange, but also extreme movements, commodity markets calling for bigger variation margin calls, found themselves challenged to find the funding to make those margin calls.
Yeah, and I want to come back to that funding point because it's really the key issue of the day. But just on talking about those OTC bespoke products, once again, I mean, you've had a period of 10 years when you've had these low prices and low volatility, and lots of those more sophisticated purchasing departments of, whether it's the airlines or whomever it may be, who are significantly impacted by unexpected rises in commodity prices. Do they still have a better way of asking this would be, do you find yourself having to do a lot more as a bank outreach and communication and education of those clients, given that many of those much of that historical knowledge might have moved on when OTC products just weren't needed anymore?
Look, I think from our approach in terms of working with clients has always been to partner with them. We've always thought about how we can work with them to give them the most efficient risk management product available. And we have, from Macquarie's perspective, we have a futures offering as well as an OTC offering. So we feel like we can provide that, and then we work with the client themselves to work through what is their particular circumstances and what level of investment do they have, to your point, in terms of managing these risks themselves, and how much of that do they want to outsource to third parties. So I don't know that has particularly, those types of conversations have particularly changed due to sort of changing staffing levels or things of that nature. I think they just continue to evolve and grow with the clients. And we do see some clients having their commodity exposures grow over time, and their level of sophistication and maturity in terms of managing those products and those risks grow as well. And again, sort of just normal course of business, I think, for people in this market.
The HC Insider podcast is brought to you by HC Group, a retained search, intelligence and advisory firm focused solely on the global energy and commodity sector. With 6 locations across Asia, Europe and the Americas, and over 50 consultants. To find out more, go to our website, hcgroup.global. There, you can also sign up for our HC Insider content for more interviews and white papers on relevant trends and talent impacts in the commodities world.
So I guess coming back to the funding piece, there's 2 distinct channels here. One is what you're talking about is, in an environment of high initial margin requirements and growing margining calls during the trade, ultimately it's about liquidity and speed of access to that liquidity. The other challenge is more systemic, which is how do you get investment capital to flow into the energy and commodities world when it's in this period of profound transition, and how do you get markets comfortable with the risks and also the sustainability challenge. But staying on that first one, liquidity in commodities, is this how profound or how significant an issue is this? And what are your comments on how people are, because there's obviously been recent calls by a number of merchants in Europe reaching out to the central bank to get support on this. Obviously there are a lot of significant exogenous impacts that are causing this outsized volatility. But can you just talk to a minute about liquidity, your take on that, and how the market can bear it?
I think it's a good question, and one that market participants had to deal with in a really acute way earlier this year, when we started to see really significant changes in commodity prices, particularly in Europe, across a number of different commodities, and not just in the energy space. And that meant just the overall requirement from a capital perspective to operate in the markets increased significantly. And the market was able to bear it. And there were large margin calls that were taking place on a daily basis, and they were made or there were arrangements put in place to finance them. And I think since then, there's been quite a lot of activity where participants in the market have gone and raised additional capital and additional funding to continue to shore up their balance sheets in the event that we start to see, significant volatility like this throughout the rest of the markets. So from that perspective, I think we have seen a really good response from the industry in terms of trying to recognise that commodity prices can move more than we expect, and when those things happen and those market gyrations take place, you need your funding to be able to stay liquid throughout those periods of time. So I have seen a lot of activity over the course of the last few months where various participants in the market are shoring up their funding positions.
Yeah, I think so. So we're definitely seeing that, but then there's still this more sort of structural issue of how do we get the investment capital required to navigate what is a transition, and it's incredibly challenging, right? I think we all understand where we're likely to end up in terms of electrification and renewables and so forth, but exactly which path that takes and how long it takes is very uncertain. And in the interim, we obviously need to continue to have the hydrocarbons available so that we don't see catastrophic impacts, on a global basis, as in terms of food prices, in terms of energy prices,
right,
etc. How, I guess, I'm just interested in your take on how do you sort of navigate that, right? How do organizations, how can companies get investment to continue to produce vital hydrocarbons or whatever it might be, whilst also, giving us a route towards energy transition?
Yeah, I think that's a challenge that the whole world's grappling with at the moment. But the reality is, you pointed out very, very accurately and clearly, I think we agree with you that this is a transition to maintain sustainable economic stability over time. We do need to transition and not just switch. So then the question becomes, okay, well, how do you finance that and how do you fund that? And the reality is, back to your point earlier, it's a repricing of the risk that we're asking people to take. So we're asking people to continue to invest in some parts of the fossil fuel chain so that we have stability in terms of energy supply, both as we transition, but also as the world's movement of molecules changes due to what's basically taking place at this point in time, and people look to shore up their supply of energy and their security of energy supply. And there's only one real way that can get done, and that is through changing price.
There is an argument out there that you sort of end up with having this sort of dual system where those organizations involved in the energy and commodity supply chain that are embracing the energy transition and whatever it might be are supported by public companies, and you're seeing that in cheaper financing for those organizations that have the correct ESG scores. On the other hand, those organizations that are investing in fossil fuels, etc., are more and more likely to go private to avoid some of those stakeholder concerns. Is that something that you're seeing? And I'd love to get your take on whether you feel a price for carbon is sort of cuts the Gordian knot in stopping that bifurcation.
Sure. Look, we are seeing an increasing role in the private sector for funding some of these projects. That is okay, and that sort of goes back to your comments on price. What we feel is important is that, as I've mentioned, this is a transition. There are needs for more than one source of energy supply to be developed, and what we're interested in is responsible ownership. So we want to make sure that there is an appropriate level of responsibility applied to the production of these types of assets, and indeed then also understanding the remediation of these assets once the useful life has been achieved. So that, I think, is a really important responsibility that financial institutions have to ensure that any funding of these types of activities doesn't just fall to an unregulated private sector that doesn't have the same level of potential oversight from community stakeholders and various other important forces that result in appropriate sustainable solutions being reached and decisions being made.
Mm. And do you see, and that's very fair comments, right? And I think it points to a whole slew of, supporting whether it's regulation, but it's certainly how other actors in the supply chain operate and how they choose their suppliers and so forth. But do you see a role? Do you think the world will get to a global price for carbon, whether that's markets or a tax? Can you talk to us a little bit about your view for where carbon is going? Obviously, at the moment, lots of organizations in the commodities world are putting together desks and investing in it. Lots of large public companies are buying lots of voluntary credits and so forth. So can you just I'd love to get your take on that.
Yeah, look, ourselves included have increased our efforts in the carbon markets globally, and indeed we've taken what was historically a regional approach, and we've coordinated that with a more global approach over the last 12 months or so. And I don't think we are alone in that effort, and we are seeing increased level of activity in those areas, like a really significant increase in activity. And some people think that this is going to be one of the, carbon will be one of the most highly traded commodities going forward. And I'm not quite sure that we're at that point yet, but we certainly see a role for the pricing of carbon. We have responded accordingly, and whether that be in the voluntary markets or the compulsory markets, we're just seeing those levels of investment increase significantly, and we're responding in that way as well. And it's very rare for us not to have a relationship with a commodity counterparty that doesn't involve some kind of discussion around carbon. So it's a really critical part of what we think of how we think the markets will evolve over time, and it's just going to be another one of these variable costs that our counterparties and our clients are going to need to manage. And our goal is to be able to help them manage that variable nature of that price and help them give them a bit more stability over their cash flows going forward. Whether that ultimately is a global carbon price is yet to be seen. There are a lot of challenges involved with that from a jurisdictional perspective, and a lot of things that will need to be worked through. But certainly over time, you need to price these things to get the correct decisions to be made, to get the right balance of supply.
Yeah. Okay, so I know you obviously don't want to talk about other investment banks, but maybe I can sort of, in my own words, frame a narrative over the last decade, which has been essentially, before the financial crisis, most investment banks, or at least in Europe and in the US, had commodity trading platforms. As we stand today, many of those organizations have either shrunk or exited commodity trading altogether. Macquarie has essentially grown steadily throughout the last 20 years to its position today, and I'll let you describe where you think that position is. But one of probably I dare say it, the only investment bank to have grown consistently throughout that period. I'd love to get your take on that, and I'd love to get your take as well on whether, as we enter a new period where volatility is returning and probably returning for a reasonably long period and maybe at a much greater level than historically, given those other complicating factors coming into this super cycle. It's no longer just a China demand story. It's very much a complicated global picture exacerbated by free trade, etc. I'd love to get you, and this is a very long question, but I'd love to get your take on the role of investment banks in managing that commodity risk, things that they can do that perhaps other organizations would struggle to do when you think about balance sheets, etc. But I'd love to get your take on, first of all, kind of Macquarie's journey within that, and then more broadly what you think the role is of investment banks going forwards in the commodity supercycle.
Yeah, sure. So look, from Macquarie's perspective, we've been committed to commodity markets for over 40 years. First off, starting back, when we were involved in the precious metals markets and then the base metals markets, and then I guess about 20 years ago when we started doing a little bit more in the energy markets. And from our perspective, it's been a really deliberate, gradual evolution of our participation in the markets, and we've grown purposefully into adjacent spaces as the opportunities have presented themselves. And generally the way we think about it is we try and understand where the clients are and what the clients need from us. And then we try and develop some products around that so that we can help be part of the solution to whatever the challenges are that they might be having. And that could be challenges in terms of looking for capital to deploy, whether that be working capital to help them manage their business efficiently, or whether it's capital for some kind of level of production of something or something of that nature. And of course, we have our risk management business where we provide hedging tools, which we've talked quite a bit about over the course of this journey today, that provide the really, really important function of giving either corporates with exposure or potential investors that want to provide equity to a project some kind of certainty around cash flows going forward that have exposure to commodities markets. And we have our exchange traded offering too, where we have a futures business where we act as agent rather than principal. And of course, we have in some markets our physical execution and logistics business, and that business is designed to help clients get things from where they're produced to where they're consumed as efficiently as they can. And as I mentioned, this is something that we've been doing for 40 odd years, and in the energy markets for the last 20. And it's been, very deliberate in terms of the way that we've grown, and we've been really consistent. And being really consistent for your clients and for your staff is really important. So we want people to know that regardless of conditions, and there've been quite a few cycles over those 40 years, that we're here to provide the products and level of service that we have throughout the journey, and our intention is to continue to do that over time. So that's sort of what we've been up to. But if I think sort of more broadly across the industry and what's the role of banks going forward, I think there's probably you can probably ask some of the other banks what they think their role might be, but I can kind of think that to the extent that we're headed into a period of sustained volatility, given we've just had a increase in volatility, so maybe it stays around for a little while. To the extent that traditionally we can provide risk management product to help our customers work their way through that, I think that's a really important role for the industry and for the greater economy. But also there's this access to funding and efficient access to funding, and then developing tools, risk management tools and products alongside our clients that help them get access to that funding in an efficient way from our clients' balance sheet perspective. And I suspect that's a role, or that type of product and service will be in high demand here for a little while, particularly as we face the challenges as it relates to the transition. We face the challenges that come from people looking for new supplies of energy from different parts of the world than they'd previously finding that supply. So all of these things create levels of uncertainty. When you have uncertainty, you want to look at ways you can manage that risk, and it also creates a lot of opportunity for new investment, and that new investment requires funding, and those are the types of things which we think we can help our client base with.
It's interesting, isn't it? Because obviously the most dominant players in the 2010s have been the independent trading houses, who have, I guess, benefited from being able to leverage their equity and scale, but very much, in a period of relative geopolitical stability and relative low volatility. And it's interesting there, as perhaps this next decade is going to lean more on the fundamental competitive edges of the investment banks and in general compared to previously. So what final question, you've got sort of from a global perspective, you've got obviously there's kind of this deglobalization comment out there, and we're starting to see that increasing great power rivalry. You're also moving from this sort of just-in-time to just-in-case economy in the wake of COVID. And you mentioned it there yourself, not only is energy transition going to mean that different products are going to have to come from different regions, we think about lithium, etc., but also you've got a reshaping of the global energy map and global commodity map in the wake of that sort of geopolitical destabilization. How crucial do you think it is to be global, and how can you even, globally speaking, navigate these new risks as they arise?
Yeah, I think that's a question we're all asking ourselves and starting to work through. And what does it mean to be global and truly global in the world that we're facing now, and the world we're going through, and so the world we'll face in the future. And I think that's something that we'll work through as in the fullness of time. What it does say is that we just need to continue to be agile and responsive, and be able to move quickly when opportunities present themselves. Because I think if we've learned anything over the last year or so, is that things change, and they change very quickly, and people who are flexible, people who are able to respond with agility and provide service, will be the ones that are able to be successful in terms of managing their risk, but also in terms of being able to provide both their clients and their own companies with the appropriate level of risk management. So what it means to be truly global going forward, I think depends on the type of company you are and the jurisdiction that you operate in. But with the things like growing sanctions and other challenges probably mean what it was like to be global, truly global 5 years ago, and what it might be in 5 years' time are probably two different things.
Yeah, it's going to be a fascinating ride. I just want to go back to, before we finish up, because I do think it's obviously a subject close to both of our hearts, but how does the commodity sector, how do you attract the best and the brightest, as it was 20 years ago, to the industry? Because ultimately, and I guess I don't want to put words in your mouth, but I feel very much like if you want to make a difference in sustainability, in the energy transition, then this is the place to be, right?
Exactly. Yeah. I mean, we're at the forefront of these conversations. We're the people who are having the discussions with people that have the biggest challenges in this area, and very often talking with people who have the largest carbon footprints and who are trying the hardest to decarbonize and to move in different directions. So you have, within this industry, you've got an excellent opportunity to make that difference. And I think the graduates of today understand that. And certainly when we talk to our graduates and our interns about possibilities for their career prospects at a place like Macquarie, these are the things that we're talking about, and we're talking about the difference that you can make, and have a really significant positive impact on the economy and the world more broadly. So there's certainly that element to it. But you also need to provide an environment where you can learn, and provide an environment where people have the freedom to develop things from a technical perspective or a technology perspective that they might not have previously had in a role like this. So there's a lot of elements to it in terms of the way we look to attract new entrants into the business.
Yeah, it's definitely a challenging world for leaders of organisations in the commodities sector and the people as well. So, but your comments help shed some light on some of the ways and solutions that organisations and people can manage it. So, well, as always, Nick, it's really good to talk. Very grateful to have you on, and hopefully we can have you back on in a year or two and see where we stand in the current array of challenges that the market faces.
Yeah, thanks for having me. I'd love to come back, and let's see what the next 12 or 24 months bring us. It's going to be really interesting.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify.
To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world. There you can also find more content from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.